Good. Well, hi there, everyone. Happy Tuesday, July 22nd, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you, as usual, from Redmond, Washington. It's a beautiful summer day here, highs in the low 70s, zero humidity, sun is out. These are the days when you think about living in the Seattle area. I used to joke when we lived in the Boston area, fall, right? Temperature cooling off, humidity melting away, leaves starting to turn. We would all say, this is why we live in New England right about here. This is that sweet spot for the Seattle area, I would say. Kind of July, not too hot, nice and comfortable, thumbs up. Fall's decent too. Winter's pretty wet, as you may or may not be aware. Speaking of looking pretty good, but challenges may be ahead. The major equity averages, right? Decent up day, right? It ended up being a positive day today. However, some interesting signs, underneath the hood, particularly the fact that the NASDAQ was down. Now, not a ton. NASDAQ down 0.4%, right? It's not a big down day. But you'll note when we look at the sector performance that technology was the worst sector. We look at the relative performance of the semiconductor ETF, underperforming here recently. So we're actually starting to get some signs of rotation, mid caps and small caps finishing decently higher while the S&P was basically flat. Now, this is one day of trading. I always encourage people not to draw long-term conclusions from short-term data. We want to draw short-term conclusions from short-term data, long-term conclusions from long-term data. So let's keep that in mind. And our market trend model remains bullish on all timeframes. But I think in this sort of environment, what's your purpose in your analytical process? I would say to track the uptrend as long as possible and to look for signs that the uptrend may be near an exhaustion point, right? We're looking for signs that we're not in inning 2 or 3, but rather in inning 8 or 9, or to continue the analogy, in extra innings, as it were. That's what it feels like to a lot of investors, and I think reasonably so, right? We've gone up a ton, right? We've had an incredible run. We're making new all-time highs again this week. Having said that, valuations are extremely elevated, right? Hard to disagree with that. When you look at technology, look at Palantir trading at 250 odd times, trailing 12 months earnings, 600 odd times versus, forward earnings. I mean, those are pretty hard to justify valuations if that's your game. Now, as a trend follower, I don't mind high valuations because that's what usually happens in a bull market phase is as we, prices go higher and higher and as earnings are not necessarily growing, valuations kind of increase. But what helps me a lot more, I have found, than thinking and complaining about high valuations is to look for signs of distribution, look for signs that things are changing. Days like this help me realize that leadership rotation may be the thing we should be looking for. We'll see. We'll look what sort of signs we can tease out together. Having said that, let's get to the market overview. We are live streaming on Facebook, LinkedIn, X, and YouTube. I appreciate you guys so much. Those that are tuning in live, welcome. Thanks for doing so. Always fun to see some familiar names in the chat. Great to hear some comments, and I'd love for you to keep them coming. Please drop questions if you are watching this live all during the live stream. We'll be together about 30 minutes, and I'd love to see questions as they come up. At the end of the episode, I'll grab a question or two to answer live. The rest will go into the mailbag. We're planning an all mailbag episode on Friday of this week. We'd love to answer one of your questions as part of that episode. So here's what the major averages look like. We can see the S&P 500 opened lower today. Midday, kind of after lunch Eastern time, broke above the zero level, and then finishing the day toward the highs of the day, just below 63.10. So we didn't make a new intraday high today. That was yesterday as we touched 63.35 for the first time, but today pretty close to that extremely high level. The NASDAQ composite, as I mentioned, down about 0.4%. Mid caps, small caps, both up. And that'll make sense if you look at the sectors. Over here, you can see the sectors that were up or down. The S&P and the NASDAQ are really overweighted toward these bottom two sectors, communication services and technology, kind of underweight things like healthcare and materials and industrials and others. The small cap and mid cap indexes very different, much more exposure to things like materials and healthcare and industrials, much smaller exposure to growthy sectors like technology and communication services. So when this is what happens sector-wise, this is kind of what happens in terms of our major averages. The VIX is telling you move along. There is nothing to see here. Out of the open, the VIX did spike up to around 1750, but by the close down about a full point to 1650. So that's down just slightly from where we finished today on Monday's session. And obviously, again, after a big spike in volatility drifting down through the course of the day. Major, I would say the VIX being below 20 is kind of telling you not too much to be worried about. Conditions are decent, long and strong until further notice, right? Low volatility uptrend. Interest rates generally moved lower today. The TLT, which is a bond ETF that we track, was up 0.6%. Means rates were generally lower. The 10-year point currently around 4.34%. The long bond yield finished just above 4.9%. The 5-year point just below 3.9%. Dollar index down about 0.5% from yesterday. So stocks slightly higher, bonds higher. Sort of the story for the day here. Other things that were up. Precious metals, right? So this week is turning out to be a pretty decent week for precious metals. You can see gold, silver, even copper were up. Gold and silver remain strong charts. The GLD, the SLV, both up about 1% today. Copper prices up 1.6%. That's for the copper ETF, CPER. You can see the energy side of the commodity space, things like crude oil, natural gas, gasoline futures. We're all in the red today. Energy, not a great sector. Finally, looking at cryptocurrencies, you can see Bitcoin toying with that 120,000 level yet again over the last 24, 36 hours. Did get down below 117,000, now bumping up toward the high from yesterday, just slightly above there. Ether prices down. Ether currently around 3,700. We'll call it down about 1.5%. And of all the things that I showed you, GLD, Bitcoin, Ethereum, and index funds are certainly disclosure-wise things that I own out of what we've reviewed. I actually don't think I own the SPY in any accounts, but I own SPY-like things. They're just a bunch of other ETFs and funds with exposure to the S&P 500 for sure. All right, looking at the sectors, you can see healthcare, number one. Don't remember the last time I've actually said that on the show. That's new. REITs, number two. I don't know if the healthcare real estate 1-2 punch is one that makes me feel particular offense. That's more of a defense kind of move, but the XLV, the healthcare sector, up about 1.9%. REITs, number two, up 1.7%. Materials, number three, up 1.4%. Utilities, number four. So three of the top four sectors are all pretty defensive. On the downside, you can see technology was the only one that was actually down. The XLK down about 0.9%. Communication services and industrials both up about 0.25%. But those round out the worst performers in the S&P. Looking at breadth, pretty decent today. And actually, we highlighted on yesterday's show some of the breadth indicators, particularly short-term breadth indicators that had come off a bit. Percent of stocks above their 50-day moving average, as an example, coming out of extreme levels. The McClellan oscillator, which is looking at the rate of change of the advanced decline data below zero going into this week. Today, actually, the breadth a lot better. Breadth in the New York Stock Exchange, 71% higher, 27% lower. The S&P 500, about a 4-to-1 ratio, with 81% of the S&P up, 19% down. So decent breadth for the New York Stock Exchange. I would say strong bullish breadth for the S&P 500 and the mid-cap index, both 80% up days for those two particular indexes. We'll look at the market carpet here in a few moments to talk about some of the themes and narratives out of the day today. But if you look at the front page here, obviously earnings, a big story. So you'll see things like NOC, is that right? Oh, yeah, NOC. Northrop Grumman up, almost 10% today. CRL, which is Charles River in the healthcare sector, up 9%. But most of the top 10 stocks are home builders. You've got D.R. Horton, Pulte Homes, Lennar, Builder First Source, whatever that is, BLDR, Builders First Source, NVR, all in the top 10 list, all up 7 to 17% in the case of DHI. So DR Horton reported earnings today, pretty strong earnings release, and so DHI leading the way leading the way higher. That was a hybrid of higher and lower. I went hoer there, sorry. Higher 17%. So the rest of the home builder space all moving to the upside today as well. It's one of the big, I guess, group themes to pay attention to. Looking at the Magnificent Seven and Friends, as I reminded you yesterday, we have two of the Magnificent Seven stocks reporting earnings this week. That's Tesla, which was up 1.1% today, and Alphabet, which is up about 0.2% today. Apple also up about 0.9% on the downside. And this is where things start to look less awesome, right? Even though the markets were slightly higher today, even though the breadth was overall pretty good, that's all good news. The bad news is some of these big dogs, the big Magnificent Seven names, were not having great days today. Netflix down 3.5%. That's after reporting earnings last Thursday. Down Friday, up yesterday, down again today. Broadcom down 3.25%, 3.33%, we'll call it 3.3%. Nvidia in the same sector, technology, down about 2.5%. So we're seeing some rotation lower, particularly in the semiconductor space. You'll see as we get to the market carpet, a lot of semis in the red today. And again, that's not the end of the world. These are not charts that are breaking down dramatically, but these are the leadership. These are the names that have been working so well for so long, and now that feels like it might be starting to change a little bit. So maybe some rotational elements to what we're seeing today. We'll keep our eyes focused there. All right, we're going to continue on, looking at the market carpet. As a reminder, appreciate your questions. Those of you tuning in live, I already see a couple questions that look kind of interesting to me as we go on. Please keep them coming if you're watching the show live. If you are watching the replay on our YouTube channel, still a great time to add questions in the comments section. We'll be doing an all mailbag episode on Friday. We'd love to answer one of your questions on the air. By the way, I'm here in the stock charts office today, kind of go back and forth between working at home and doing things from the office where there's some great video production capabilities. I was in here earlier today recording a second half 2025 market outlook with Grayson Rose. We had about an hour-long discussion talking about lessons learned in 2025, what the charts looked like at the end of 24, how that changed through a couple key junctures, some of the ways we thought about navigating off of the April low, the conditions now and looking forward. We talked about seasonality. We talked about leadership. We talked about the Fed. Really good discussion. Hopefully that's posted very, very soon. Should be later this week on the Stock Charts TV YouTube channel. I did not do a show on Stock Charts TV. I usually do a show on Monday, but I held off because that second half outlook special is going to be coming out here very soon. Keep your eyes peeled on the Stock Charts TV YouTube channel, where there should be a really good second half market outlook coming out very, very soon. All right, here's the market carpet, which is basically a high level view of market conditions, but also allows us to go pretty granular and look down at the stock level as well. I mean, what stands out to you? I mean, a couple things just almost jump off the page at me. Number one, in the upper left corner, and the weakness in technology. Technology has been hands down the strongest sector in 2025. It has been the most impressive sector off of the April low. It's been the strongest sector in July of 2025. So whatever real look back period you probably look at, technology's at or near the top of the list. But getting dinged today, pretty good. So some of the leadership names pulling back today. Nvidia down 2.5%, as I mentioned. Broadcom down 3.33%. Applied Materials, LRCX, Micron. These are all semiconductors. KLAC, all in bright red here, and others as well. Right, names like CrowdStrike that are outside of the semiconductor space. Western Digital, which is basically hard drives, all in the red. As well. So, at this point, what does that mean? Is that a huge negative sign for the markets? Maybe is I think the only way you can answer that question. Anyone that tells you for sure, yes, this is super bearish, or no, it's not super bearish, I think is making a big assumption about what's going to come next. I'm not prepared necessarily to tell you I know the future. I will tell you, having gone through a lot of market tops over the years, the beginning after the market has gone higher and you have that initial rotation lower, a garden variety pullback, which is actually a very healthy thing within an uptrend, and the beginning of a big sell-off, they look very similar right at the beginning. They look almost identical. And I would argue it's very hard to tell the difference. So the difference is what happens next, right? In a tactical pullback, we pull back to an ascending 21-day exponential moving average, or at worst, an upward sloping 50-day moving average. Then we bounce higher as long-term investors are thrilled to buy great companies at a brief discount. They go back in and add to positions that provides the next leg higher. If, however, that initial run of selling leads to additional selling, if we rotate into more defensive sectors, if we rotate out of offense, you'll start to see things rotate lower very, very quickly. And even if investors are just rotating within the S&P 500 names, by selling out of those big growth names that have big weights in our index, the S&P and the NASDAQ are going to drop a lot more than if it was like an equal weighted S&P measure, right? Where it's not going to be as exaggerated. So rotation out of tech is definitely going to weigh on the S&P and the NASDAQ if that persists. So I think using some good money management strategies, keeping an eye on lagging moving averages to see if they hold, pretty important right about now. So I would say the weakness in technology, certainly one of the big takeaways that I would have. Another one would be the strength in healthcare. Look right in the middle of the market carpet. Names like Amgen and Merck and Pfizer and Tech and HSIC and Biogen and WST. I mean, these are stocks that represent a number of different groups within healthcare. And besides a couple like HCA Healthcare and United Health Services, UHS, most of the stocks in this sector are doing, at least S&P 500 names, doing pretty well today. It's been a while since healthcare has been a truly strong sector, but certainly seeing a move higher there today. Last thing I would say, just in terms of exaggeration, some green peppering into these defensive sectors. And again, I think it's too early on to be, to be declaring like a big rotation from offense to defense. But today, for example, sort of a rotation of sorts out of growthy tech into defensive sectors like consumer staples, healthcare, REITs, some of the more defensive areas of the market. We'll see if that persists. And I would say if that trend continues in the days and weeks to come, that's when this market can have a very different complexion. Top of mind for me is the seasonality, because while July has been 100% of the time a strong month since COVID was initially discovered, August has actually been relatively weak, and September has been, I think, the worst month of the 12. So we're entering into a seasonally weaker part of the year. I'm looking for signs of rotation. Today is definitely a rotational kind of day. What else? So other kind of, earnings related gaps here that you're going to see. Lockheed Martin, I actually didn't grab that chart, but I do want to bring it down because it was down pretty good today. They did report earnings here today, gapping lower. That's an ugly drop, isn't it? We're going to look at the unadjusted data. Let's see where we're actually at. Yes, we made a new 52-week low using the unadjusted data. And if you're wondering what I just did and why, that's because when you're looking at a stock like Lockheed Martin that has a pretty decent dividend yield, anything above like 2%, what normally happens is you adjust the price data. So when they report earnings, you adjust the historical data to match the new value of the stock, and that's a pretty widely followed technique in sort of the charting industry inside the financial space. But if you're actually looking at price levels relative to where we've been, you want to take that adjustment off because you want to look at the actual prices where stocks were traded back over time. On stock charts, you can add a little underscore before the ticker, or you can click down here where it says adjust for dividend. It's probably going to look like this. Just deselect that. And the whole kind of historical data is just going to click a little bit, but it's a better way of just understanding where we're at relative to where we've been, purely looking at price. You can see Lockheed Martin at 410. That's the lowest we've been over the last 2 years. Now, when you have a big gap down like this, a big sell-off, I think follow-through days are important. So look what happens tomorrow. Do you see investors buying into the weakness now that we've digested the fact that, Lockheed Martin is down $50 from one day to the next? Do you see buyers coming in through the remainder of this week, thrilled to own Lockheed Martin at a discount, in which case that gap maybe starts to get filled and you start to see signs of accumulation? If, however, this is at the beginning, you're going to see further price lows, new 52-week lows through the remainder of this week. But certainly an ugly chart. And I'd also say with charts like this, what do? Zooming out to the weekly time frame, bringing in a lot more data and just seeing, are we near any levels going back where we found support before. You can see back in 2023, a number of times in 2024, sort of that 400 to 420 range is where we've often seen lows. If we don't find some sort of meaningful bottom right around current levels, this starts to look like a big distribution move with downside potential. So concerning drop for Lockheed Martin overall. And again, that's the benefit of a visualization like this in my experience. It's easy to focus in on stocks like TPL that look very different than the rest of energy, right? This is down over 3%, while the rest of the S&P energy names were nowhere near that bad. Helps you find Philip Morris down 8% today. This is another chart that has been one of the better charts in 2025. Certainly one of the more consistent leadership names. Look for how long in 2025 Philip Morris has been above the upward sloping 50-day moving average. As a matter of fact, you pulled back there in early April. The April low found a bottom around the 50-day. We've been sitting on the 50-day for the last couple weeks. Today, gapping down below the 50-day moving average. Now, if you look to the left on the chart, you can see we're right at the May low. So I would say at this point, the chart's not great. And unless you see some sort of bounce off of the support, I think this is a really disastrous move for Lockheed Martin. But I'm also noticing the distribution here in terms of the weaker momentum, particularly in the month of June. Look at the higher highs in price on weaker RSI as we retested those highs about a week ago. We have a much lower momentum. So the momentum has been turning more negative. This is what concerns me about this market. Charts like Philip Morris look really, really great until they don't. And, obviously there's no way to predict necessarily that a stock's going to gap down 8% around earnings, right? I mean, that you can guess that, but it's hard to really predict that ahead of time. But what is easy to see is that we are heading upwards on much weaker momentum, which tells you if the news is underwhelming, there's already been some kind of profit-taking skepticism priced in. And so, we can go down very, very quickly. So another chart certainly to keep in mind there. I think that's it for the market carpet. Some random things to think about there. By the way, I do want to thank our partners. Koyfin have been a great friend to Market Misbehavior, helping support the channel, helping me make Market Misbehavior awesome. I'm so thankful for that. I'd encourage you to check out the platform. Koyfin is one of those things I use every day. I use a number of different platforms. I think it's important to have multiple platforms for, duplicating some things. So if one system goes down for any reason, you have a backup. That's called redundancy. That's something I learned as a student pilot, that if you over rely on one particular system or platform or thing, if it goes down, then what do? So you have redundant systems. If something goes down, you can go to the backup system. So having other systems ready to go is super helpful. Koyfin I found valuable because it has rich fundamental data. It has good coverage of global markets. So I'm going to be doing a webcast tomorrow for an Italian community, a bank based in Milan, and I used Koyfin because they had great coverage of the Italian markets, and I could look at big weights in their indexes and break down some of the charts. Also great to dig into ETF holdings, which I found very, very helpful, so you know what bets you're actually making when you buy a particular ETF. If you want more information, go to marketmisbehavior.com/Koyfin. You can scan the QR code that you see on your screen. If you use my link, you'll get a little better deal than if you just go to their website, and helps me make Market Misbehavior awesome. So thanks again to Koyfin for being great partners, and please check it out if you're interested. Marketmisbehavior.com/Koyfin. Koyfin. All right, let's continue on using the stock charts platform and looking at some really interesting charts. We're going to start, as always, with a daily chart of the S&P 500. Yesterday, we talked about what I would call a gravestone doji, which is what we saw in yesterday's session. Today, almost the opposite, right? Almost a dragonfly doji of sorts. But this week definitely feels like sort of an indecision week. We'll see. I mean, the S&P really has kind of stalled out a little bit. You're seeing the market drift higher. The momentum has generally been going lower. Today, a little bit better, though. The RSI is really starting to improve here. And if you would see the RSI break to a new swing high, that would be a great signal of further upside to be had. That was what we were observing back here in May and June. And one of the things that we noted on this show was when the RSI finally broke above a trend line connecting those recent highs. That tells you, all right, the momentum is actually strong enough that it's no longer a divergence. We're back to higher highs on stronger momentum. And that was one of the things that suggested us to remain sort of optimistic there at the end of June because we had a breakout on stronger momentum. So that's what you're looking for here when we start to see a divergence. Most likely we're near an exhaustion point, but market goes higher on stronger momentum, and that would give us an all clear. So I'm definitely noting the fact that we're having some divergences here in terms of price momentum, not just on the S&P, but some other charts as well as we, go through the month of July, which is a seasonally strong month, going into August and then September, which is one of the weakest parts of the 12-month period going back here. For now, higher highs and higher lows are bullish. Let's keep an eye on that momentum. This is a chart we featured yesterday. I just wanted to point out they had a nice spike and the percent of stocks above their 50-day moving average. Just in the last day, we went from around 65% to almost 75%. It's about 10% of the S&P made broke above their 50-day moving average today. That's pretty encouraging, right? That continues. I think that gives you a pretty good sense of the broad strength of this market. Market moving higher on weaker breadth is something to be concerned about. Market moving higher on stronger breadth, a little bit better. So let's keep an eye on, see if those breadth conditions continue to improve. Gold, a pretty impressive chart. I'm showing the GLD, which I own in my own accounts, as well as the IAU. I've had positions in gold for a while, quite simply just because the charts have looked very, very good. And I'm a big fan of owning good charts, as I sign up in every episode with it's always a good time to own good charts. And back here, I remember people asking, like, why would you own gold? Are you super defensive? It's like, gold's going up. I like owning things that are improving and the price is uptrending. I mean, that's what I'm trying to identify, and it fits the bill. The GLD is back, making potentially a new high. We'll see if it's able to finally eclipse kind of this 315 to 318 range, which is where the GLD first topped out back in April. But to draw a quick line on here, I would say this almost looks like a what you call an ascending triangle pattern. That's when you have a consistent resistance level. You kind of have these inclining support. Let's see how we have the rally, and then we have this ascending triangle. An ascending triangle is when the lows are getting higher, but the highs are pretty consistent. So flat resistance, improving support is called an ascending triangle pattern. The trigger, right? The buy signal using this traditional pattern will be a break above that upward trend line, which means breaking to new highs is vital, right? I mean, it's absolutely vital, because what it does is it suggests to you that we're now making, we're now to a higher level than we've been. So that's just below 318. So I would say the GLD above 318 all of a sudden looks like a fantastic chart, because it would suggest we are breaking out of that ascending triangle to the upside. We're showing real signs of accumulation. That'd be a new 3-month high for the GLD. I think there'd be a really bullish breakout. Very, very close. That's where I would certainly encourage you to set an alarm, set an alert. That is, I am making a note to do that as well after the show. All right, next chart, Alphabet. We talked about this on yesterday's chart. This is the infamous, well, it could be a couple things depending on how you call it, but using a traditional candlestick analysis, I'd call that a hanging man candle, which is actually a reversal candle, which means when this pops up, suggests the next 1 to 3 bars are lower. So it's actually a bearish sign that you had that candle today. It's where you open, trade lower, but by the close, you're right back at the top. The fact that the open and close are so similar is a reversal candle pattern, according to the candlestick best practices, suggesting Alphabet lower for the next 1 to 3 bars. If we would rotate lower, I'd be looking at that breakout level, that 61.8% level. I think we talked about that on yesterday's show. The 21-day EMA right around there as well, right around 181 or so. So keep an eye on that. So bearish candle pattern as we become overbought, certainly something to watch. Now, Nvidia dropped today, down about 2.5%. We haven't had a down day like this in almost a month, so it feels pretty jarring, I'm sure, for one of the biggest names in the benchmark, down 2.5%. It's really not the end of the world. I mean, this chart is still a strong chart. We're still making higher highs and higher lows. However, it's not going up on this particular date. It's interesting because the RSI was overbought, actually extremely overbought about a week ago. Now we're selling off today with the RSI coming out of that overbought region. The daily PPO indicator generating a sell signal today, certainly something to keep an eye on. As we've had this really good run for Nvidia, it's certainly been one of the top performers, and helping the semiconductor space be such a strong area of the market and certainly of the technology sector. Today, though, pulling back a little bit. So this is certainly a theme to be continuing to watch. I didn't bring up like the SMH, but that's another one. I mean, the relative performance of the semiconductors ETF has been remarkably strong. Today's drop is about 1.8%. Takes us almost down to the 21-day EMA. That's often sort of my first warning. If we hold that on a pullback, it's like nothing to worry. Like, don't even think another second about it. But if we break below the 21-day EMA, that's when we have to start to revisit it a little bit. So keep an eye on there, because again, we could be seeing some signs of rotation here in terms of leadership. We looked at Netflix here the last couple shows, I want to say. On Friday, which was this day here, we gapped lower. They reported earnings on Thursday. The stock had rallied going into the earnings report. It was not a good report. The stock was down on Friday and actually pushing below the 50-day moving average. Yesterday, a bullish pattern. We talked about this being a bullish piercing line pattern. That's a 2-candle pattern. We have a big down day and you have a big up day. Day two's close finishes at least halfway above the mid, or at least above the midpoint of day one's open to close range. So we close back above the 50-day bullish candle pattern. But what I also mentioned is when you have a 2-candle pattern, the low of that 2-bar pattern is the stop that's built into that candlestick analysis. So today, closing back lower to 1190, that actually negates that bullish candle pattern and reinitiates a bearish, short-term signal for Netflix. So the stop built into the candle patterns did not hold as of today. That is not the positive follow-through we'd be looking for after yesterday's bullish candle pattern. That actually suggests, nope, we're probably heading more downside for Netflix. One of my premium members asked about Tesla. As a reminder, the Market Misbehavior Premium membership, I love going deeper with a smaller group of motivated investors. A lot of individual investors and financial advisors are premium members of Market Misbehavior. You can find more info at marketmisbehavior.com/premium. Always looking for a couple new premium members, so take a look. Use the code YouTube when you check out for 30% off your first 12 months on any plan. But every morning, I'm in our members-only community answering questions from our previous members and from our premium members. And this was a question that I got off of a weekly chart of Tesla. It was trying to put this recent choppiness into context. And the question was like, what we're seeing right now similar to what we saw like in the teens? And the answer is like kind of, right? I mean, we had a big rally. This is the IPO back here in 2010. And then you can see the big rally in 2013. Then from 2014 really through 2019, this is a big sideways chart. Some random new highs, some random new swing lows. But overall, on the weekly time frame, you can see this is sort of a sideways big rectangular shape. But then look at how that changed in the beginning, end of 2019, beginning of 2020. We had this big spike higher to $60, a retest of the breakout point, and then it was lights out uptrend, as we went up many, many times over. But from 2021 through 22, 23, 24, and now so far in 25, we're kind of back to a new consolidation phase, again, on the very long-term time frame. So what makes this a bullish chart? I mean, I think you're looking for this kind of move. I think until and unless Tesla can get out of this congestion zone and break to new highs, I mean, that's what it would take to go into a new accumulation phase, again, on this long-term time frame. So when things get squirrely, when things get noisy, when it's tough to get a read on what's happening with any stock or ETF, I always tell people, when in doubt, zoom out, bring in a lot more data and see if it can help you put things into proper perspective. Defensive sectors. We're noting in the month of July, utilities now becoming the third sector, having a decent month now. And that's all really happened in the last week as the XLU has started to improve. The relative strength of the utility sector now starting to hook higher. Today, you saw some little upticks for healthcare, for consumer staples, and for real estate. It's still a little too early to say that these are now really starting to outperform. But this is one of the more important charts I would argue to watch right about now. If there is a top, and if we sell off, as we often do, into August and September, the 4 lines you're seeing here should really start to improve, because these are the relative performance lines tracking the 4 defensive sectors. Utilities starting to emerge. Do you see improvement in the rest of those sectors? That's one thing I'd be looking for. Finally, home builders, nice breakout. If you look at the ITB, the XHB, which are 2 kind of home construction ETFs, look at individual names like D.R. Horton. Today's earnings release from DHI, really helping to accelerate the uptrend that we've observed here in Q3 from the home builder stocks. DHI with today's gap higher now breaking above the 200-day moving average from the first time since early December of 2024. So it's been a hot minute since DHI has been back above the 200-day moving average. Let's see if there's further follow through on tomorrow's session. But overall, I would say a nice improvement in the healthcare sector. Oh, excuse me. Home building group is what I meant to say. Sorry, I glanced down. This is why I am not a great multitasker. I'm trying to read the chat and finish my comment. Can't do both of those. All right, some great questions here. Let me take a question or two. Larry, a longtime viewer of the show and frequently in the chat. Great to have you as always, my friend. You said, Dave, is Netflix bar today is make a confirmation of breakdown of support? No, it's a good question. I think so. And I would say the chart of Netflix for me is concerning here. And as we talked about, right, I think, for me, charts are so helpful because it helps you really just respect the message the markets are providing back to you in terms of price action. So the way I think about it is when you analyze a chart, you always have a certain point of view, and then you also have kind of your exit strategy, right? What I always think of it is, here's what I think the chart is saying. Here's my conclusion. But if XYZ happens, then that's no longer the right thesis, and I need to change my opinion. We kind of got to that point yesterday where the discussion was, and I'm paraphrasing what we talked about on the show, this is called a bullish piercing line pattern. It happened right at the 50-day moving average. That suggests the next 1 to 3 bars is up. I think that's a decent reason to make like a swing trade attempt at something like that. But the other part that we talked about, but if we break below the low of that 2-bar pattern, which is yesterday's low, that would negate the bullish outlook of that candle pattern and basically say, nope, you're stopped out. This is suggesting more further weakness. So I think the fact that instead of bouncing off of the 50-day today, the fact that we're actually making a new swing low and continuing this move lower that's really been in place since the end of June, I think that's a further weaker sign for Netflix. I don't have a position in Netflix. If I did, I would most likely be out. Or at least have a partial position unwound because of the deterioration that we've seen. And I think this week's price action sort of confirms the fact that a tradable low is probably not in place just yet. We need to reassess and probably analyze using some other techniques to try to triangulate a short-term low. But I think that is totally fair. CR10s, thanks for watching on X. Can you publish a list of the 5 to 10 key candle patterns? The short answer is yes, I can. The question is, do I make the time to do so? I hope so. We've actually talked about quite a few candle patterns on this show, I want to say, or it was sometime I actually hand drew some common patterns and held them up to the camera and explained what they were on my list to do a little bit more about that. But I want to say it was on the Stock Charts TV channel. I'll have to look at where I actually did it because I did do a video. Oh yeah, here we go. It's called I'll put a description below, and sorry it's showing an ad right now, but I do a weekly show on Stock Charts TV. That is the Stock Charts YouTube channel. I did this show last week, not this week, but the week prior, from hammer to harami, using stock charts to crack the candlestick code. I share with you some of the key candle patterns to follow and what sort of levels and patterns to look for. So check that out. I'll certainly be doing more content. I've been, it just kind of happened by accident. I've been incorporating more candlestick charts into the shows and commenting on them, and I'm getting a lot of great feedback, from a lot of people, and I'm a huge fan of it. And it's reminding me how much those little visualizations of price action can really resonate. So I'll continue to do so. Keep an eye on this channel for sure. Market Misbehavior, as I put out new content as much as possible. But that'll do it for today's episode. I want to thank you guys so much. Those of you, Team Market Misbehavior, tuning in live. Great to have you guys as always. Hope you enjoyed the discussion and hope some of these comments and suggestions were helpful. Please check out our YouTube channel called Market Misbehavior for all of our great podcasts. I just interviewed Adam Koch earlier today. He's a financial advisor based in the Columbus, Ohio area. So a fellow Ohio State grad, but we talked a lot about technical analysis for financial advisors, some of the ways that he uses charts to enhance relationships with his clients, how he structures his investment process around charts, a lot of lessons learned from 2025, et cetera, et cetera. So keep your eye peeled for that episode coming out probably tomorrow morning on the Market Misbehavior podcast. I'm Dave Keller with Market Misbehavior. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.